All right, so I want to welcome everybody to our meetup tonight. Just to remind everybody that feel free to put your information into the chat if you'd like to connect with other people. For those of you that don't do a lot of Zoom meetings, if you click the three dots at the bottom of the chat, you can save that at the end and you'll be able to save people's contact information so that you can do it. This is also being recorded. So if for some reason you have to step off and do something, we can send you a recording. I'm going to do just a quick introduction about the meeting and then we'll get going. Awesome. So we're the multifamily investing group. For those of you that have not already joined our Facebook group, I'm going to put a link into it and that you can go ahead and join our group. We put a lot of information there. James is the main sponsor of this Facebook group and our meetup, and he's with Chief Investments Group, and he should be joining soon, and I'll let him do a quick introduction of himself. I'm from Niagara Investments, and our goal here is to educate passive investors as well as active investors. The format, we start around 7:30. It's an hour long. Use the chat to tell us something. We do a 20 to 35 minute presentation with Q&A. And then we do about 20 minutes breakout room. This meetup happens every Thursday at the third Thursday of the month at 7:30. Everything is free. Please feel free to invite people to come and join us. Our whole goal here is to educate. I want to make sure that this is everything here you should take as entertainment, educational purposes only. You're always going to want to consult your own legal, tax, or financial. We're not offering any investments here a little bit tonight. So we have Chip Simmonds, who's going to be speaking with us. And as I mentioned earlier in the meetup, I saw this presentation when I went to another meetup in San Antonio and really enjoyed it. And Chip's been so gracious to come in and do it for us here tonight. So without further ado, Chip, I'm just going to let you start, share your screen. We're going to get right into it. And again, at the end, we're going to have Q&A, so we'll unmute people. If you're nervous about doing it, you can also put it in the chat, and I'll make sure that we get your questions answered. Awesome. And
good evening.
Are you capable to share as well, Chip?
Yeah, let me share my screen. First of all, my name is Chip Simmonds. Good evening. I'm a CPA in San Antonio, and my wife and I have quite a bit of real estate experience. We've been in real estate since 2012. We're part of the San Antonio Apartment Association. So they approached me and asked, hey, can you prepare some slides for our group, the IROs? They're the independent rental owners. I said, sure, I'll put something together. And I asked them, give me what kind of topics you want me to discuss, because this is where how I glean the information for the slides. But before I get into the slides, I mentioned my wife and I have been in real estate since 2012. We started with single families. We built a portfolio of about 10 single family properties. And at that point, when we had to move into a portfolio loan, we decided to start selling some of those single family, capturing the equity and then utilizing and deploying that equity elsewhere. Well, my wife Kelly syndicated a 50-unit multifamily with about 10 partners. She sold that. She ran it. She was the operator, and I just took care of the accounting and tax functions. We sold that 4 years later for about twice the purchase price, so a very nice return. We used that to move into a larger multifamily. We have right now, and we bought that in February of 2020, just as COVID was hitting, so it's become quite a mess, but certainly something that we've learned from. I started this firm about 2 years ago after we sold that first multifamily property, and this is kind of these are the slides associated with an independent rental owners and passive and active, investors. So within real estate. So I gave this in August of 2022, and kind of like Trevor, I have a disclaimer. I want to make sure that you guys understand that everybody's tax situation is different. I want you to take a look at these slides, but be very careful. I don't want you to rely on them as tax advice. Now, I am a CPA and I know quite a bit on real estate. However, I need to ask you to take the slides. You can take them to your CPA or your attorney and have a discussion with them, but be very careful. I don't want you to take these as pertinent or absolutely in line with your own situation, because I haven't seen your situation. So your CPA or your attorney would know your individual situation. And my point number 2 on this disclaimer is, generally when you ask a CPA a question, about a tax situation, their answer is, well, it all depends. And the reason they say that is because it's so difficult to know all the different facets that have an effect on your individual tax situation and your real estate investments. So it's funny, it just seems like next time you'll notice that if you ever ask a CPA question, I bet you their answer is, well, it all depends, and they'll ask for clarification is, are you married? Are you, so just keep that in mind. But with that, I'll move into the first slide. They asked me to kind of explain the businesses, the structures of what type of business you can create within Texas. And again, this is kind of structured for Texas. And in Texas, an LLC is a very flexible organization, and it can be created into 4 different functions or entities. Your first entity is a C corp, okay? And you may know a few aspects of this, but I'm going to try to talk and run down a few of the tax aspects of each organization, and the goods and bads. The good thing about a C corp, it's a very formal organization. The one thing about it that most people understand is there's double taxation with a C corp, so it makes it a little bit more undesirable if you're in real estate. It's certainly not a good place to place appreciating assets. A C corp is not good for appreciating assets because of this double taxation. If you were to have a property and your C corp owns it, and say you hold that property for 4 or 5 years and it goes up 20-25% in value, and you sell it. Well, when you sell it, whatever the gain is, you're going to be taxed right off the bat, with whatever profit, because not the sales price, but the profit on that, or the capital gains, but at 21%. Okay. So once you pay, the corporation pays the 21%, then you got to get the cash out of the C corp. And the way to do that is either through payroll, dividends, or maybe a loan. But the first 2 there, you're taxed. You've got income tax on your payroll, and if it's a dividend, then you're taxed for dividends on your personal tax return. So C corps are a little more difficult to get cash out of, and they're not exactly a great place for appreciating assets. No corporate structure, for that matter, is. So when we move into the S corp status as an LLC, and you would file the paperwork with the Secretary of State of Texas, and they ask you, what do you want to be? And you'd say C corp, S corp, partnership, or single member LLC. But if you choose S corp, this is a pass-through entity. So it's not a double tax, but it's a pass-through entity, that whatever profit or whatever loss, flows through into your personal tax return through a K-1. So there is no tax on a sub S entity on that corporate level. So it flows through, goes into your personal, and you're taxed on whatever profit, or you get a deduction if you have the basis and there's losses in your personal through the K-1. With an S corp, it's not a good place to put appreciating assets, for the matter that say you have multiple shareholders within the corporation, and he wants out, or a couple of shareholders want out, and they just want the other shareholders to buy them out. Well, if that's the case, and you buy those, you buy a few shareholders out, it could create a taxable transaction where, again, say we've got 20-30% increase in value. The S corp wants to keep the asset, but the shareholders want to be bought out. You need to be very careful, because if you buy them out, or it could create a taxable transaction on that appreciation of that asset. So again, an S corp, not terrible, but not the greatest place to put appreciating assets, because it could trigger that tax on the appreciation of the asset that you don't want to sell. Okay, so you want to keep the asset in the S corp without selling it, but by getting some of the shareholders out, that you have that appreciation taxed and captured by the IRS. And one other situation with S corps is if it's it could be just two shareholders, a husband and a wife, and they're 50% shareholders. Well, if there's a divorce, man, that's a terrible thing. But what also happens is if they've got appreciating assets in their S corp and they get divorced, well, they're going to have to separate assets, and that whatever gain you have that's unrealized on that asset, it becomes taxable at that point. And just usually they'll just have to sell that particular asset to settle through the divorce court. So very sad. Now, another item with S corps, you need to be sure that you pay yourself a reasonable salary if you're profitable. The S corp, then the IRS doesn't really care if you're at a loss. They just want to make sure you have the basis before you take any of the losses against your other active income. But if you're profitable, they don't want you to utilize an S corp to avoid payroll taxes, because that's why they require this reasonable salary. If there is net income, again, it passes on to the shareholders based on their ownership percentage of shares, of the total outstanding shares. And that's what's reflected on the K-1. And then your CPA puts it into your personal tax return. The third organization is an LLC tax as a partnership. Partnership has to be more than one person. Generally, what we see is a lot of spouses. And in Texas, it's not a problem to have a husband-wife partner. Some states, they have a problem with that. But in Texas, it's not. It's a pass-through entity as well. And again, you get a K-1 with whatever profit, the net profit is on that partnership, the business, flows through into the partner's K-1 and then into their personal tax return. There are no wages that you pay to partners because they have to be guaranteed payments. And this is kind of the tricky part of a partnership, is that your guaranteed payments are reported on a K-1, but there's SE tax on that in your 1040. So if you're a limited partner, there is no SE tax, but generally there are no wages or guaranteed payments to LP limited partners either. But a partnership, it is a good place to put appreciating assets, because let's take that divorce. Let's say a husband and wife are partners and they get divorced. Well, that appreciated asset at that point, there's not a taxable event if you break up. You just get the basis. There's no taxable transaction at that point, and it's a matter of, okay, what happens with the asset and how does it get split? But it doesn't necessarily trigger a taxable transaction. What an LLC is a single member. This is just it's not a husband and wife. It's just a single person who wants to create an LLC. You default into a sole proprietor tax status if you don't elect to be an S corp or a C corp. You can't be a partnership with a single member LLC because you have to have more than one person for a partnership. The problem with sole proprietors or proprietorship on Schedule C is that there's no asset coverage or protection. You don't have to pay yourself any wages because they're not deductible. It's just whatever the net profit is on a Schedule C, it's taxed at 15.3%. That's if you're in a business and you're getting a payroll, you're going to pay 7.65 in tax for Social Security and Medicare, and then the company is going to pay 7.65. They're going to match it. And here with a Schedule C, your net profit just gets taxed at 15.3. So, there are ways to maneuver, and you may want to be an S corp in order to avoid the 15.3. You just kind of have to visit with your CPA or your attorney to find out, again, what's your individual circumstance look like, and what would behoove you. If you're just starting out, maybe it's sole proprietorship, because you don't have a lot of assets, perhaps. But once you start accumulating assets, maybe it's time to convert to an S corp. The last point on this slide is very, very important not to commingle business and personal accounts. I can't emphasize that, because if you're trying to protect your assets by creating an LLC and a separate entity, you need to be very careful that you don't commingle business and personal, because an attorney, certainly an opposing attorney, would pierce the veil and say that the entity is also an alter ego. It's basically an alter ego of yourself. Therefore, there are no separate structures, and they would be able to go after all your personal assets. So, personal, I know it looks like it's misspelled, but if I put an O in there in the A, then it would have messed up my slide. So my wife pointed that out to me. I said, no, I meant to do that, but if you'll excuse that. But I'm going on to the next slide. There are three things to think about when you go to your CPA. Three things that you want to write down. One, you have to have a business. You got to have a business. Your expenses have to be ordinary and necessary. And then the third thing is you have to document it. Okay, those are the three particular pillars that you need to always think about if something's deductible. But with the slide, I wanted to just kind of, with those three items in mind, I've already pointed out the ordinary and necessary expense to create a profit. Okay, so that to create a profit is the business. That's the first function or leg of the stool, if you will. The second leg of the stool is that the expense needs to be ordinary and necessary to create a profit. Okay, and then the third leg of that stool is documentation. And some of the expenses that are generally overlooked that I wanted to point out with this slide are cell phones and internet. If you use any of those for any portion of business to make a profit, they're fully deductible. The IRS allows full cell phone and internet as long as you use it to create profit within a business. You also have the home office. Where I am right now, this is my home office. So I've carved off within our house, this square footage as my home office that I actually do work on. So that allows for certain expenses to be reported on 8829. But I want to keep in mind, continuing education is also a deductible expense if it's helping you, helps you, again, create a profit or get better in what you're already doing as a business. Mileage logs and time logs, those tend to be overlooked as well. And if you say you want to take mileage, your CPA may ask, well, do you have your mileage logs? Or if you want to be a real estate professional, do you have your time logs? We'll generally want to look at those to make sure that if there's an audit, that's what the IRS is going to go for. They're going to want to look at your documentation, and that's what mileage logs and time logs are for. Along the lines of number 3, the home office. This is reported on Form 8829, and a lot of people don't realize that your homeowner's insurance, your mortgage interest, your property taxes, utilities, lawn and landscaping, your pest control, your security system, snow removal, and even your maid service, based on the square footage of your home office. So those would be deductibles. So they're not 100% deductible, but if you've got just for quick count, if you've got 1,000 square foot house with a 100 square foot office, then that office represents 10% of your total square footage. You'd be able to take 10% of these expenses on Form 8829. and your CPA should be able to help you do that. You don't want to take any more than that because that's how you would justify it, and you'd have generally you want to make sure that there's pictures of the home office. It has to be exclusive use for business, so you can't have a bed and a couch. However, that doesn't mean if you have an apartment that you can't carve out a certain amount of space that you devote to business. So even apartments can have a home office. So an item that we often see as areas that we can help people save money is kind of utilizing what they have that they may not think is deductible, and that's a home office. And I do want to interject that having a home office, I've heard, is a red flag. I've heard people believe it's a red flag, but it's not. As long as you have the proper documentation, that does not create a red flag. What would create a red flag with the IRS is if you've got 1,000 square foot house and 50% is a home office. That would shoot up a red flag with the IRS because the ratio just doesn't make any sense. That 50% would shoot up a red flag. But if your home office is anywhere around 10 to 15%, generally you're going to be okay. It just those kinds of items would create a red flag if your home office is exorbitantly large compared to your entire house. So real estate memberships came up, and they were asking, are we allowed to deduct some of the costs that we have for real estate memberships? And the answer is, well, it depends. Remember the first three things that for an expense is you have to have a business. If you don't have a business, then you get no deduction. You can actually deduct on Schedule A as miscellaneous item unreimbursed business expenses. However, that is subject to 2% of your adjusted gross income, and it has to be over a certain amount. And it certainly has to be over your standard deduction. So if you're married, filing joint, you get almost $25,000 in standard deduction. You're probably not going to have miscellaneous itemized deductions of unreimbursed business expenses to that extent. So you lose them. So to that extent, your real estate memberships wouldn't be deductible. You'd have to have a business. And if you do have a business, and you have no revenue, well, you're going to need to be able to, on number 2 here, you're going to need to prove the profit motive of the business and justify that the business exists to create a profit. So very difficult to do if you're trying to attach an expense to no revenue. And they may look at that. Now, I'm not saying that it can't be done the first year, but certainly the second year, that may cause a flag. If a second year, you don't have any revenue, but you have expenses for the first year and the second year. Be very careful there. The third, if you have a business with revenue, then what you have to do is make sure that you justify the business purpose for the expense. Is it ordinary and necessary? And the third thing, do you have the documentation for it? So they are deductible if you can document that they're properly they're ordinary necessary business expense. And what I see with some of the real estate memberships is that you're utilizing those arenas or that environment to network, to find deals, and to just make business contacts. Now, if you do have these real estate membership fees, now, how are they deductible? Well, generally, if they're over more than 1 year, then you just divide by however many years that the membership is, and that's how you divide the expense to be recognized in the particular year. So if it's a 2-year, you get 50% in 1 year, 50% in another. You can, generally, you don't want to capitalize these expenses. You'd rather expense them as dues and subscriptions. That way you get them immediately right off the bat, for your tax return. And that's number 5. They also wanted to know, well, what should we be getting to our CPA? When should we get it there? And how should we get it there? Well, we're in mid-December now, but as I mentioned in August, this was my presentation. Mid-November to early December, you'd like within your business, okay? Again, your business. You want to have your company year-end tax planning for summary discussions with your accountant. For year-end maneuvers. There's a couple of weeks left. You may want to call him, shoot him these slides, and say, "Is there anything that we can do these last 2 weeks?" And have a discussion with him. Try to have your Q3 buttoned up for your financial statements so he can review, because we can project after 3 quarters, what your fourth quarter is going to look like, and get an idea where you may end up, even though you haven't closed the fourth quarter. Okay, but if you've closed October, then November, we can utilize that information to project what's going to happen for year end. And is there anything we need to get done this year? Because in February or March, it's too late. At that time, if we need to make a maneuver, a tax saving or mitigating maneuver this year. So moving into the subsequent year, after you've made your moves, early February of the subsequent year, you should get portal access from your accountant. You shouldn't want to email these documents because they're very sensitive, and email is a little bit more susceptible to access to others that we don't want access to it. So a portal system generally is more secure, and there should be a portal system set up with your accountant for you to share documents. Within the early February, once you get the portal access, the accountant will want to see, hopefully, about 80% of your materials uploaded before you really get started into the tax return. And the reason we want that is we don't want to get started into a tax return, do 20%, and then move off to somebody else, and then come back to you a week later and have to think about, where did we do another 25%? It puts more time in the tax return. So generally, you'd want to make sure that your CPA, you don't want him to start and do that either. You'd like him, to start when you have a good chunk of material to be processed, to be done. Certainly the goal would be 100%, but at 80%, that tax return can get assigned and can get started. As far as March 1st, you'd hope to have 100% of your tax documents uploaded if you wanted to avoid the extension of time on March 15th. So March 15th is the first tax deadline for partnerships and sub-S's. Those are due March 15th. Now you can get an automatic 6-month extension, but you have to file that form. So with CPAs, they really need to get your materials in before, or you need to get it in and uploaded by March 1st if we want to try to avoid a March 15th deadline. Now, say you get 100% of your materials in on March 10th. They may be able to get it done. We're working pretty crazy hours at that point in time to make a deadline. And a lot of taxpayers don't want an extension, but they may still be able to do it. But you'll have to ask them if they can do it. That generally they may need to put an extension out. And let me tell you, an extension doesn't cause an audit. I've heard a lot of taxpayers think that does, but it really doesn't. Moving on to point number 4, if you want to avoid a personal tax extension, you need to have your tax materials uploaded by March 31st. Okay, so before April starts, that gives us 2 weeks to get everybody done by April 15th, and that's the personal tax deadline. So keep that in mind. Again, same with number 3. If you get all your materials uploaded on April 10th, April 11th, it may be very difficult for the CPA to process that tax return completely and accurately and filed before the April 15th deadline. He may need, or she may need, to extend. There's a question on cost segregation, and they asked me to just kind of elaborate a little bit about what a cost seg is. And what a cost seg is what it does is we don't just, when you buy something on the settlement statement, it has total purchase price, cash due seller, cash owed by buyer, and it just has, what's the total purchase price. Well, that's just not buildings that are depreciated over 27.5 years. What we can do is do what's called a cost segregation. It qualifies the certain assets of a building. There are multiple facets of a building, and that's they're listed here. You've got the land, which is not deductible. You've got buildings, you've got roofs, the pavement, the landscaping that's with the asset, appliances, cabinetry, floors, fans, doors, and the underground irrigation system. These are all items that you'll see both in single family or in multifamily. But what we do is we compartmentalize all the parts within the purchase price down to these little subcategories and components. And these components have much lower lives, smaller lives than the real estate, the actual building, which is 27.5 years for rental properties. Excuse me. Commercial properties are 39 years. So what we want to do is with a cost seg, we want to try to pull as much of that purchase price down below 20 years so that we can accelerate that depreciation through bonus depreciation. And that gives us the possibility of a 20 to 25% write-off of that purchase price if we can compartmentalize it properly. Now, imagine you have $1 million purchase and you can either depreciate the $1 million over 27.5 years. Well, that's 27,000 every year. Whereas if you can get 20% of that that purchase price in the first year, that's 200,000. So you're talking about a big tax savings if you're say you're in the 40% tax bracket. 40% of 27,000 and 40% of 250, 200,000 to 250. That's the 20 to 25%. It's a big difference. It's a big favorable difference that you could utilize those tax savings. Now you're using the IRS's money that if you didn't do a cost seg, to deploy and invest in other passive activities. So number two, the cost benefit of a cost segregation. Well, it could yield the potential write-off of the assets up to 20 to 25% of the purchase price. Real estate professional status is important here, okay? Because you need the rep status in order to really take full advantage of the losses that are generated through depreciation in your real estate. If you're just a straight up passive limited partner, these may not help you unless you sell a property. So there's always something in this part right here. Sale of property in the same year is helpful. So if one of your passive investments sell in 1 year and then you redeploy in another investment, you may want that syndicator to do a cost seg so that it accelerates the depreciation on that property, and you get your portion of that accelerated depreciation to offset the sale of your other passive investment. Something very important to think about. It's also called a lazy 1031, just so if you wanted to make a note of that. When does it make sense to pay for a cost seg? Cost segs are a little bit more expensive, all right, because there's quite a bit of analysis and there's a lot of documentation the IRS wants to see because they don't like to see 20 to 25% accelerated depreciation. If they can disallow it, they will. So they make sure that you have proper documentation and how you came up with all the different measurements and how you came up with the components of the purchase price down to asset lives below 20 years. So if you don't do it right, they can disallow that. And there's a big tax hickey if they disallow. That's bad news as far as penalty and interest, because your taxes would go way up. So for a single family residential rental, I don't think it's worth the cost seg, the cost of a cost seg. You may just want to depreciate that 27.5 years. It's a bit subjective. I'd get with your CPA or your attorney and ask them what they think. generally I would think, a threshold of 500,000 is an area. So if you bought a vacation house, for 750,000 or anything, over 500, maybe that's at the point where, you want to do a cost save to accelerate some of that depreciation. But a conversation to have with your accountant or your attorney. All right, moving on. Rep status. I mentioned this in the last slide. What is rep status? And that's the REP. This is real estate professional status. So if you're straight up passive investor, then you're just going to be a limited partner. Okay. This is like a syndicator. Anybody that's or if you're managing your single family units, you could qualify as a real estate professional if you satisfy the IRS requirements, and those requirements entail 750 hours or more with material participation. And that's the management. You don't hire a management company to find your tenants and to vet your tenants, but you're actually doing that, or you could be helping the management company do that as well. But you need to have material participation, reading financial statements, making decisions, what to buy, when to pay for it. These are all material participation ideas that you need to spend 750 hours. And remember those time logs that I mentioned? You need to track those, because the IRS would love to be able to disallow rep status because there are a lot of benefits to it. Rep status allows your losses to offset your active income. So a couple of things that are very important with this is the 750-hour rule. At least those many hours material participation. You cannot be a full-time employee anywhere else. You can be an employee, but you can't be a full-time. There's 2,080 hours in a year. You'd have to, if you're a full-time employee, you have to spend more time in real estate than any other job. So your employee status, you'd have to work 2,081 hours. I'm not taking in vacation or anything, but 81 hours in real estate. It's just, it won't work. Now, you can be part-time, and as long as you do more in real estate than you do in your part-time employment, you should be fine, but you got to document it. What's a strategy that's really, really helpful here is if you're married and one spouse is a W-2 and the other spouse runs the real estate, manages it, and they meet the 750-hour test, and the most time spent there in real estate and managing, one's a rep, one is a W-2. This is how my wife and I became quite successful. Is I was a CFO before I started out on my own, and we lived off my W-2, and we took her losses from her real estate, and we offset my W-2, and we paid very, very little in tax comparatively to what we would have if we didn't have that rep status. Excuse me. So one spouse working as a W-2, another spouse as rep is a very good strategy to offset W-2 income. That's your active income. A couple more slides, and then the IRO, I mentioned to them, Form 8582. This is a passive law limits. Now, you guys should all be aware of this form. If you're passive investors, your LPs, this is one of the most important forms, if not the most important. All right, I'll go ahead and say it's the most important form in your 1040. Okay, so it's a part of your Form 1040. Go look back and look, because it's 8582. It's probably in the back. But what it does is it shows you what your suspended losses are. Okay, and these suspended losses are huge. You don't want to lose track of this. If you ever move from one CPA to the next, you better make sure that new CPA tracks that 8582 forward, and you get credit for whatever suspended losses you had with the prior CPA. Okay, be very careful about that and mindful. I suggest that everybody go pull their prior year tax return and go look at their 8582. This is the passive loss limits form, and it documents all your suspended losses from passive activities, and until they can be realized. When they're realized is when you sell one of your properties. Then those suspended losses, they come into play, and they can offset the gains from that property that you're selling. You know, as an LP, the depreciation or the losses that may have been shared or come through your K1, you may not have gotten the benefit of them because you're just a limited partner and they go in suspended status. This allows you, when you sell a property, to have an idea. Okay, well, what's my suspended losses on, and what's the tax consequences going to be if we know what the sales price is going to be on that? Because we should be able to track our basis, and anything over our basis is capital gains. But we also have those suspended losses, and you don't ever want to forget those. And your CPA he won't. It's so important that they'll understand what suspended losses are. Now, when some people think about doing a 1031, they don't think about looking at this 8582, because to do a 1031, and a section 1031 is a like-kind exchange. So it's like asset for like asset, or property for property, and the tax is deferred. So if there's a gain on one, it's not realized when you purchase a like asset. The taxes just kick down the road, it's deferred. But there's a lot of I's that have to be dotted, T's that have to be crossed, time stipulations that have to be met within a 1031. And again, the IRS would love to come in and disallow a 1031 because that provides them tax revenue. Okay, so if you're not dotting your I's, crossing your T's, and meeting the timeframes within a 1031, they could disallow it, and there's a big unfavorable adjustment there. If you have the losses already in your 8582, that could answer your question right then and there. I don't even need to do a 1031 because we have the suspended losses that are going to come forward when we sell this property, and it's going to mitigate most of the taxes to such an extent that a 1031 may not even be worth it. So, big item on the 8582 to consider if you're thinking about a section 1031 like kind of exchange. Okay, one last slide. I think this is no, there's one more after this, but short-term rental. So there's this short-term rentals are a property that you have that they're rented less than 7 days average for the year. These are your VRBOs or your Airbnbs. If they're rented for less than 7 days, then this is called a short-term rental, and it's also called the STR loophole. So the STR loophole, it allows you that if you're a W-2, you can take the losses on an STR loophole. You can take the losses against your W-2 income, but you have to meet the 7-day average requirement. You can't go over it. Now it's an average. So if one person rents it for say 10 days, and then everybody rents it for 4 or 5 days, and the average falls below 7 days, you're going to be okay. But the average has to be 7 days. You have to materially participate in this as well. At least 100 hours, 100 plus hours, and this is managing your VRBO or your Airbnb, and you're making material decisions. You have to offer hotel services. This was the hotel lobby requiring this so that these STRs wouldn't pop up everywhere. And the hotel services are you're providing soaps, maybe fresh towels, shampoos, that type of stuff. You're cleaning it. It doesn't have to be every day, I don't believe, but you're cleaning it, and as most people do for short-term rentals. But those are the kind of requirements the IRS looks at. On number 3, I lumped this in with STR because the Augusta and Super Bowl rules. The Augusta rule came about from the Augusta golf championship, where people were let me just say, you're allowed to rent your house up to 14 days and pay no taxes. You pay no income tax, but you don't get to deduct any expenses either. But you rent your home for 14 days or less and you pay no taxes. So it's also called the Super Bowl rule, so that when say the Super Bowl comes to town and you want to take a vacation, you can rent your house up to 14 days. Let's say $1,000 a night, and you rent it for 5 nights. You've got $5,000 that you don't have to pay any tax. You don't have to claim it. You don't have to pay any tax on it. But and people use that revenue to pay for their vacation when they go off during those, like the Super Bowl, when they utilize the Super Bowl rule. So if you're thinking that this could be something, talk to your CPA about. If you've got a business, Kelly and I, we rent our house out. We just had a networking function here at our house, and we're going to deduct a cost of renting our house out to the business that was utilizing the space to network, which we got the benefit of networking. So we plan on doing that and utilizing this Augusta rule. Keep in mind that long-term rentals fall under the passive loss rules and regulations. That's the Form 8582 that we just went over in the previous slide. STRs are exempt from that, but you have to make sure you meet these STR requirements, okay? The short-term rental. And again, this is called the STR loophole. So this is my last slide. And I want to emphasize, I'm not an attorney. I'm not giving you guys legal advice, but what I'm trying to do is give you guys some help on, if you don't have a business, how to start one. If you wanted to create an LLC and you needed to, you wanted it to be a C Corp or an S Corp or a partnership or a single member LLC as a sole proprietorship. Well, this is kind of a little bit of a guidance as to how to do it. You got to go to the Secretary of State. You got to research name availability, and there's a phone number. You can call them, and somebody can answer, and they'll search it for you. You can't take Bill J. Simmonds and Company CPAs. That's ours. So that's taken. You can't take McDonald's. That's taken. But what we'll see is whatever the address of your property is, that's a pretty unique name for a business, and we see this a lot. It's 407 Broadway LLC, or just come up with your own name. Our management company's name is SBK Asset Management. Our children's name, Skylar, Brianna, Kyle, SBK. There's how creative it is. So you come up with the name availability, and then you file the paperwork. It usually costs about $300 to form the business. After you have the name availability, go to corporation section for forms and business and nonprofit forms. You'll find form number 205, certificate of formation for an LLC. You'll fill that out. That'll be the $300. You'll send it into the Secretary of State. Then you'll go, once you find out that your name availability, you can go to the IRS, while the state's processing your paperwork, go to the irs.gov, do a search in the search box, put EIN, and it'll take you to apply for an employer identification number. You are the owner, you're the principal. So it'll ask you who you are, what are you doing, what do you want your entity to be taxed as? You have to do the exact name of what you're filing with the state, and you'll just go through and boom, they'll send you a PDF right there with an EIN assigned to you. Now you're in the system. They're going to be looking for a tax return. And the last point here. Oh, and at that point, you can go to the bank and open a business bank account, because we don't want to commingle business and personal. So at that point, when you get that EIN, you may want to wait until you get your Secretary of State paperwork back. But then, I think you can still go with your EIN to the bank and open an account. And once you do have all the paperwork, then you can certainly go to the bank and open a bank account, a checking account for operations. And then the last thing here again, please have your attorney review the filings, with anything that you do with the state, to ensure that nothing's missed. You're creating the LLC for tax advantages and to protect your own personal assets. So you want to you want to have an attorney review the filings, so to make sure that all the I's are dotted and all the T's are crossed, and get their feedback on it. That's it. I hope I didn't go too long.
Awesome. No,
A
that's
lot of
great.
information.
Yeah, we do have a couple of questions.
Yeah.
Is an S corporation income profit subject to self-employment tax?
So no, it's not. So the pass through of the S corp, the net profit passes through to all the shareholders, but there's a section on the tax return that is officer salaries. Okay, they want to see, they want to make sure that you're not utilizing the S corp to avoid payroll taxes. So you may recall on my first slide, S corps require a reasonable salary, and you come up with a reasonable salary so it justifies that you're not utilizing the S corp to avoid payroll taxes. However, uh, you can pay yourself, a reasonable salary and save quite a lot of money on payroll because as long as you do a reasonable salary, then the rest can flow through without payroll taxes into your bank account, or you can take a distribution basically without payroll taxes. But so when there is net profit, they want to make sure that you do pay yourself some sort of salary so that there is some payroll taxes and that you're not utilizing the S corp to avoid payroll taxes. Okay. Very important.
Yeah, and so they also asked the minimum, but the minimum is just what's normal and reasonable for whatever services you're providing to yourself, correct?
Yeah, I would suggest you visit with your accountant or your attorney on this, but I see a lot of the default calcs as, oh, just take a third. I think that could be a little high because, you want to consider, well, you're not doing CEO work the whole time. You're doing, you're doing the admin work, you're doing the janitorial work, you're doing it all as if you're the
Right.
business owner. And that's up for consideration on your reasonable salary, which, you make sure that your accountant and attorney consider, which brings it down. Okay. You want that, you just want it to be reasonable.
And the next question I want to make sure, so the minimum amount of income you should earn to convert an LLC to an S corp, but I'm not sure because an LLC can be an S corp, correct?
An LLC can be, yes, it can be an S corp. And that's when you'll tell the state, you certainly tell the IRS. No, that's who you'll tell the IRS. The LLC is at the state level. They just want to know your name and that you want to be a limited liability company, and they want to know who the members are and who's the managing member, who's the members. And then the IRS, they want to know, well, how are you going to be taxed? And you decide C corp, S corp, partnership, or a single member LLC.
Right. And I think this next question you did answer, they talk about the home reimbursement. How do you calculate it? It's really the percentage of square foot use versus the reasonable bills paid, correct?
Yeah, so normal bills paid, and it's just the square footage of the home office used exclusively for business, divided by the total square footage of the house.
And then this
So,
other one, maybe it's so in a series LLC, is there one bank account with a parent for the LLC?
so with a series LLC, no, because what you're trying to do, you're trying to avoid multiple tax returns. You just want them all consolidated into like a parent company. But your series LLCs should have separate bank accounts because they're all separate entities. Okay, so we see this with single family businesses that have multiple single families and they want an LLC on each property. Well, if you don't want to have a tax return, an S corp or partnership tax for each one of those, so they do series, it's called a series LLC, and that folds up into one parent company. But you should have because each one is a separate entity with separate bank accounts. It makes it a little bit more but you avoid the multiple tax returns.
And someone just asked the question, what is self-employment tax?
Okay, so the SE tax is what it's called, and that's the sole proprietorship. That's Schedule C on your 1040 or your part of your Form 1040, and it could be just your business, and it's usually just you, and your business income comes into it. You offset your business income with your ordinary and necessary expenses, and you have them documented. And say your total revenue is $10,000 and you have business expenses of $1,000. I'm sorry, you have business expenses of $9,000. So your net profit is $1,000. So that's your net profit. Your SE tax is applied to that $1,000. So if the SE tax is at 15.3%, again, that's the 7.65 twice, you're paying both sides of it as a self-employed, then that's $1,530 in tax that you have to pay the IRS on $1,000 profit. So that's the SE tax. Now, there is a small deduction you get for that large amount of tax, but that's a separate calculation on your personal tax return. But
Okay,
if we can
and I should have
avoid
asked you to
that
stop
SE,
sharing too, just so we can see each other here. See the main
Okay.
screen. Thanks.
you want me to stop sharing?
Yeah, just to make
Okay.
sorry, I should have said that. There we go. We got lots of questions and we're kind of running out of time. So, but I'm okay. So one of the questions here, if you have a high W-2, does an S corp bring you down to 20%? But that's chicken and egg, right? Like a W-2 job is, unless they hire your company.
Okay, so
And I
say
may
that
have asked
again.
that wrong. I don't know if Cynthia can unmute and ask, or if you can't, I can unmute you. If I can find you.
Hi. Can you hear me?
Yes.
Yes, I can hear you.
Oh, well, I have I have a new rental, a short-term rental. I have a high W-2 and I'm building a multifamily triplex on my primary residence as well. So I'll end up having multiple units of rentals in the future. And my accountant is advising me, because I pay a 35% tax rate right now, that if I become an S corp, I'll have two benefits. One is that I can itemize and deduct for losses, but also that it will bring me down to a flat tax rate of 20%, and that my entire taxes will be taxed at 20%. Is that right? I don't know.
That's not an S corp. That's a C corp.
She says S corp, but I thought that that's my confusion, and so that's why I was clarifying.
Yeah.
So that's
Yeah,
all.
yeah.
Probably at this point, it's a little too detailed for I would stick with your accountant for,
Yeah,
that's
that's
just direct advice for yourself. And James, I don't know if you want to hop on and say hi to everybody. We went a bit long. Sorry about that for those that wanted to get in breakout rooms.
Hey, no worries. I'm sorry, I just could not
It's been
join
lots
earlier.
of good information.
Can you guys hear me?
Yes.
Yeah, I just want to say hi to everyone. Thanks, Bill, for coming and joining us. I know Kelly very well. She's one of our investors too.
Yeah, she told me. It was funny.
Good.
I
Say
didn't
hi
know
to
that.
her.
I will.
So, all right, good. Yeah, let's go with the questions. There's a lot of questions coming in. This very beneficial session.
Yeah. Yeah. And as I said, the recording of this will happen. And one of the last questions we'll do, and then if people have to leave, they can, and we want to do one breakout room, you can leave after this. But W-2 earners utilizing their losses from caste segregation, if I understand it correctly, the passive losses only go against your passive income, correct? It does not go against your W-2 income.
That's correct. Now, because it's very difficult to get the rep status, the real estate professional status, but if you can get that rep status, say through a husband and wife, or spouse, then their rep status, any losses produced, they're not subject to the passive loss suspension. They can offset the W-2, but it's very difficult to have a W-2 and be a rep status all in one, especially if you're working full time. It's almost impossible. But if that's the case, you're not going to hit the rep status, but you may be able to. You're still actively participating in the rental. You may qualify for a $25,000 allowance on losses against your W-2 income if your adjusted gross income is less than $100,000.
And correct me if I'm wrong. So let's say I got a big accelerated bonus depreciation. I have a W-2 job, but then that particular property sells and I have a big gain. Then those passive losses go against the gain, correct?
Yes. Yeah, then those suspended losses can come in and get activated.
Yeah.
The
And
one area that they won't offset is if you do a cost seg and there's some depreciation recapture, your passive losses cannot offset that depreciation recapture. And that's just the IRS saying, well, you didn't hold it long enough. Therefore, we're gonna claw back some of that depreciation you took in the previous year. So
excellent.
this is very important. And this is very important. If you're going to be a passive in a syndication and you ask the syndicator, are you going to do a cost seg? And he says, yes. Your next question should be, how long are we going to hold the property? If he says 2 years, well, that could be a problem. It won't be if you're just an LP because you don't get the benefit, but that depreciation recapture is something you definitely want to talk to your accountant about is this good or bad? Because you want that property to be held quite a bit longer than just 2 or 3 years, because you want to avoid as much depreciation recapture as possible. Okay, so good question.
I'm about to find out what happens on that. I have a property that big depreciate and a big profit. So now luckily I am personal real estate status now, so it was okay.
Okay, good. Yeah.
Awesome. That'd be good to know. Yeah, I have a quick question, Greg. Now that I'm on the call with you guys, thank you for putting on the presentation. It's just at the right time that I came on to. I appreciate all the information you've given in this webinar. I do have a quick question though about so if I have a business, like in the first quarter, we've got about $384,000 worth of revenue coming in. Now, at what point should I go from just a sole prop to LLC or a C Corp or S Corp? I'm not even sure which status I should take, but.
Sure. So your first quarter, what's your profit? Because that's what's going to be.
Profit probably going to be we got profit and overhead marking in about 20% of that. So it's pretty typical.
For 20%. This is moving from a sole prop to an 1120S could be very beneficial because you're not going to have to pay as much in payroll taxes, and you'll get the benefit of the profit flow through it after the reasonable salary. So, I can't tell you what the reasonable salary would be, but when you get to that point, that you're just paying too much in tax, it's time to convert. Or your assets, you're accumulating so many assets that you want to protect them. It's time to convert into a sub S. And very few instances do I recommend C Corp status unless you're doing some sort of dual corporate strategy. But that's beyond this conversation. But in S Corp, whenever you feel like, man, I'm paying way too much in SE tax on my profits, I'm going to pay a hell of a lot less. I'm going to move to an S status. You want to make sure you're profitable at that point, and then you only pay taxes on your reasonable salary, and then the rest flows through as distributions without payroll taxes.
Okay.
Yeah, this has been great. We're already 15 minutes past Chip's bedtime. No, only kidding. But this was fabulous. It was a lot of really good information, probably a lot to absorb. We are going to post the recording. And again, our goal here is to provide you with good information that will help you become a better passive earner of your income or an active earner of your income through investing in commercial real estate. I know all of you know me talking about James's book all the time, but I know Lucy, I sent it to her this yesterday. I met her at the luncheon Tuesday. Ken mentioned your book, and I sent the link for about 10 people to order your book. If I got a nickel every time somebody got a free book, I'd be rich by now. But you've got to read that book. It's an awesome book. and want to keep going. And thank everybody so much for coming tonight. Thank you so much, Chip. This was incredible. A lot of really good information. We'll be sending out the replay for everybody. Please invite other people to come and join us. Please make sure that you're commenting on things on our Facebook group. James, you want to end us out here? Yeah,
I just want to say thanks to Chip, and make sure you reach out to him. He's a very credible CPA. He's in our, I'm in Austin. A lot of people Austin, but there's a lot of people from San Antonio. I think he's based out of San Antonio, but I think he's very well versed with a lot of, real estate site, all the questions about taxes. So go ahead and reach out to him. And did you give your contact information, Chip, to everyone?
Yeah, it was the last slide.
Okay. Good. So you can go and share that, and you can share it in our Facebook group.
And then I also put in the chat here, someone asked about the Facebook group. We try to post a lot of educational material there. Please feel free to comment, and we want to make that site a little more interactive. I work hard at trying to keep out all the spammers that are trying to sell you stuff and try to provide good quality information. If you go there too, there's a great webinar that James just had done a couple of weeks ago. Man, it's just full of you got to watch it probably 3 times just to.
Yeah, you have to watch it. You have to watch it 3 times to understand what Casey Conway is saying. There's so, you will understand definitely, but there was just so much information in economy, and you just have to listen.
James, what's the name of your book also?
It's called.
Well, I put the Facebook group in the chat.
Well, the book that you mentioned earlier, James' book.
Oh, Passive Investing.
Passive Investing in Commercial Real Estate.
Yeah. Okay. And send me a note. I can send it to you. I've got it on Audible, and there's also a link that if you register, James sends you out a free hard copy. And if you're lucky like me, awesome. I got an autographed one.
Oh, did you? Yeah, I might want to get one of those. That might be valuable someday. Yeah.
Well, I autographed 200, 300 books today for my investors because we're giving it as a Christmas gift, and that was interesting. Took us 1 hour to sign, 1.5 hours to sign all of it.
Good stuff, guys. This is pretty good.
Right. Cool. Awesome.
Happy holidays to everybody, and we'll see you in the new year. And as always, if you need anything, just reach out to us, and we'll make sure we get everything to you. Thanks so much, Chip.
Awesome.
Yeah, thank you.
Thanks, James. Thanks, everybody.
Thank you all.
Have a good night.
Thank you.